Good afternoon and good morning, everyone. We are a couple minutes away from launching this webinar today and outlining Fannie Mae and Freddie Mac's new condo and co-op guideline release that came out on July 5th and goes into effect in September, on September 18th. So give us a couple minutes and we'll allow some time to get everybody admitted and launch on time and provide you with some interesting guidance today. If you're just joining, we're about a minute away from launching our webinar. Thanks for attending, and I want to make sure there's everybody has a chance to join, but we are going to be starting on time. And it's a quick one today. It's a half-an-hour webinar, hopefully providing you with some interesting guidance and direction based upon the new guideline releases. So give us a minute or so, and we will launch into this. Okay, so it is 1 p.m. Eastern. We have attendees here today from across the country. So some people on Pacific time, some people on Eastern time, and some people on Central time. So thank you very much for attending today. This webinar is designed to give you a little bit of guidance on the new Fannie Mae and Freddie Mac guideline release that came out on July 5th. Both agencies recently updated their condo and co-op lending guidelines. And we wanted to provide you with a little bit of an outline on what these new guidelines mean and the impacts that they're going to have and they're currently having within the industry, within the lending industry, property management industry, to condominium boards, to purchasers and to owners of condominium cooperative units across the United States. We have a pretty full house today. I think we have over 250 attendees or registrants from various walks of life. We have a lot of lenders who are clients of Condotek that we provide our Condo Project Warrant and Condo Pack Product 2. We have a lot of developers on this call who build new condominium developments across the country. We have a lot of realtors on this call, brokers and agents on this call, and sales and marketing teams, because they want a better understanding of what's happening within condominium lending and condominium requirements. So without further ado, let's launch into this. So I'm Orest Tomaselli. Most of you know me. I usually keep a close relationship with most of the people who are attending today. And if we haven't met, very nice to have you on this webinar today. I'm the president of Project Review at Condotek, and I routinely review hundreds of condominium developments across the United States for lending compliance. Our team, on average, reviews around 2,500 condominium and cooperative projects a month whether that's obtaining documents for those developments and or doing a review on those developments for our lender clients across the country, or working directly with our new construction development teams across the country that build new condo housing. We see a lot of condominium developments, and we do a lot of reviews. So we're a great resource in the industry for good information on what the trends are within the industry and what the impacts that lending guidelines are having on the sale and lending within condominium and cooperative developments. So at Condotek, just a little bit of a shameless plug, we have a very systematic approach for collecting documentation and collecting documentation on condominium cooperative developments with multiple data points and looking at a lot of historical data on condominium cooperative developments that we have and that we've acquired over the years. We have a really significant relationship with data providers, whether that's management companies or individual condominium associations or cooperative associations that provide the data that's needed for lender review to provide residential mortgage financing in these developments. And, it's kind of become an important part of the process for lenders to have an arm's length third party providing condominium and cooperative documentation to ensure the validity of the information that's being provided, so they can make the appropriate decisions upon lending or about lending in the site or in any particular site. So the focus for us really is to provide the most up-to-date, exact, accurate information about a specific condominium property or cooperative property, so our lender clients can make the appropriate decision on lending through our Condotek product and through our condo project warrant product, to ensure that we're reviewing those documents for compliance with Fannie Mae, Freddie Mac, or secondary market investor lending requirements, which has become a big, kind of arena in the condo lending world of late. So we review condominium documents for those, not only for the lenders across the country, but directly for those secondary market investors, and underwrite to their specific condominium lending requirements. So, in 2022, as a result of the tragic condominium collapse in Surfside, Florida, we saw the agencies issue new lending guidelines for condominium cooperative properties. And those guidelines were incredibly impactful and have resulted in many condominium developments, becoming non-warrantable, where you can't provide mortgage financing into those developments through Fannie Mae and Freddie Mac, and also non-warrantable through secondary market investors. And, originally, my opinion was, wow, these are very difficult guidelines to comply with. And I've kind of formed an unpopular opinion over the last, 6 months or so, which is that, upon review of a lot of these condominium developments, there are many condominium developments with significant problems and significant issues. And the issues that the agencies have outlined are really lending risk issues. They're not, some, irrelevant guideline that's, come to the marketplace that we have to comply with, but they're really significant guidelines or, requirements for condominium cooperative properties. And they revolve almost entirely around critical repairs that are necessary for the property, significant deferred maintenance, financial health of a condominium association and a condominium property, and looking for physically unsafe and financially unstable condo and co-op properties, so they can identify the risk in lending in those particular properties. So I've kind of come around, and the come around has been, well, based upon the fact that I have seen hundreds of condominium and cooperative developments that, very frankly, and I'll pull out my, my New York playbook. I wouldn't lend those, associations $5, let alone giving them a, essentially warranting a loan within those particular properties. And there is a percentage of properties that I, of course, would lend in and would lend $5 to. And there's a percentage of properties that I would not. So let's go over that, number first, right? So we see out of all the reviews we do in condominium properties, about 70% of condominium developments that we review are really good lending risks and don't need any significant work. They've been managed appropriately. They have substantial amounts of capital in reserve for critical repairs or repairs that are necessary, because very few of those 70% have critical repairs or critical repair issues. And are great candidates and easily lent in with Fannie Mae and Freddie Mac loan products, as well as secondary market products. About 20% of the projects we see are, need a little bit of work, need a little bit of help. Maybe they're not 100% of the way there, but they're close, and we could typically get them over the edge. And around, 10% of the developments out there that we see are those developments that I wouldn't lend $5 to, really managed poorly and have massive litigation or litigation that's going to impact the homeowners, and very little reserves in the bank, haven't been following any sort of reserve policy to set aside capital for repairs and replacements, and have some sort of physically unsafe issue within the development. So to kind of fast forward into what this meeting is about today, there have been several new guideline, updates into Fannie Mae and Freddie Mac's guidelines, right? And so the guidelines were released on July 5th, or the updates were released on July 5th. And from Fannie Mae, they go into effect on September 18th on all new loan applications after that date. Their focus is almost entirely on critical repairs, significant deferred maintenance, special assessments, and there is some guidance in here that there are some questions about on whether or not the requirement for review of reserve studies and engineering reports is a mandatory one. But the way the guidance is written, there may be a mandatory requirement for review of reserve studies and engineering reports to assess the property condition if they exist. And we're concerned that if they don't exist, that they're going to have to exist, that associations are going to have to go out and get some sort of professional engineering and or a professional engineering report and or reserve study report performed by a professional engineer, so that we can get some guidance, so that we can get some indication on whether or not the property is in good physical and structural condition. There is an update to what the 2022 guidelines are, and effectively what these guidelines state is that the 2022 temporary guidelines that were put into place are now permanent. And these permanent guidelines are not going away. And there was talk back in 2022 that Fannie Mae and Freddie Mac were going to, loosen the reins on these guidelines. I personally never thought that that was going to happen. I thought that the guidelines were going to become even more restrictive from a lending perspective, just because of the risk that the agencies have in providing, insuring these loans and buying these loans. And I think I was right. So when you look through these guidelines, and I'll throw them up on the screen for a second, just to address them appropriately, so you can see what we're talking about. There are several different new guide bulletins, right? So the selling guide announcement that came out from Fannie Mae outlines really clearly the fact that, the project review requirements defining critical repairs, material deficiencies, and significant deferred maintenance, including defining routine repairs that are not considered critical, as part of these new guidelines and part of the kind of the risk evaluation of these condominium properties. It's a really important point to stick on first. So we have an issue across the industry where this information about critical repairs or material deficiencies or significant deferred maintenance over the last couple of decades has not really been provided to lenders to make a lending decision. And only since these new guidelines have come out are we seeing that the industry is struggling with providing the appropriate information so that a lender can make the appropriate decision about lending and compliance with agency requirements. And one of the things that I kind of outlined first is lenders are kind of tasked with creating or finding a way to get this documentation in, because there are thousands of condominium developments that, when asked these questions on a condominium questionnaire, just will not answer them. And they've been advised by condo counsel or by their insurance company not to answer these questions. And it becomes incredibly difficult to get this information. And what we do great at Condotek is really, creating a systematic approach so that we can gather that information from multiple data points. And one of the points I want to make to you today about this is there are ways to get information about properties and condominium properties and their condition. One of the ways is to look for any violations that have been issued by a municipality. That's one of the first things we see in title reports, or we look for in title reports when we get them, is to look for those violations and determine if those violations really put a property at risk, or whether they're impactful based upon these critical repair guidelines. And sometimes they are. And those violations issued by municipalities, you can't hide from them. They're there and they're easily found in public records. And that's one of the things that we're finding on a regular basis. It's not all bad news, though, because in some instances, those violations, or when those violations are cleared, kind of pave the way or give you the pathway to provide a condominium project approval, right? And to get a loan done within one of these properties. So that's one of the things that's routinely searched, is the violations on a property. Litigation on a property also is an area where we really dive into when we're looking into a condominium property and determining compliance, because that litigation often gives you, clues as to whether or not there are really major issues in the property or not. Now, on that point, I'll say there's a lot of frivolous litigation that we've reviewed over the last, couple of decades, and we have seen a lot of frivolous litigation that's been filed against condominium developments. But by and large, litigation on a site is really a good identifier and lets you know, again, whether or not there's some sort of critical issue or critical repair issue within a property. The other piece that we look at is really delving into and this is really good advice for a lender. I mean, not that, most lenders that we work with actually kind of have this on lockdown. They actually know how to do this very well. But sometimes when you have exhausted all of your, abilities in getting condominium documentation or documentation about repairs or condition on a property, obviously we try and get engineering reports or reserve study reports, which are becoming incredibly popular across the industry, for the specific purpose of ensuring that there's, compliance with these lending guidelines. But often we look at meeting minutes, if we can get them, to see if there's any specific issues that have been brought up, over the last 6 months or a year in a specific condominium property. And that usually sometimes leads you to an answer. I'm not a big fan of looking through meeting minutes because, there have been instances where some frivolous conversations have resulted in projects being removed from, eligibility, and they really had no basis, and there were conversations that happened within the kind of the privacy of a condo board meeting, that really weren't impactful, but brought up an issue that really wasn't an issue within the development, whether it was a unit owner complaining about something that they didn't like in the development and calling it a critical issue or critical deferred maintenance issue or not. We've seen that happen a lot. So the point here is that there's a lot of different ways to get this information, and to get this information on condominium developments and cooperative developments developments that you typically wouldn't look for, or look in the areas where we're looking in order to gather that information. And the advice to lenders is when, because this has become such a big issue and because this has now gone into permanent guidelines, this is something that you really have to address and create systems around in order to make sure that you're lending appropriately within these developments. So moving forward, mechanical issues are big issues that have come up recently. And those mechanical issues include, like, a good example of one is, a replacement of an HVAC unit, right? Where, and I've used this example before in other seminars that we have provided, but when you see a condominium property in Maine that has to replace their HVAC unit and it's October, well, if it's the air conditioning in that property, it's not that big of an issue. If it's the heating system, it's incredibly impactful, right? So you have to really delve into these mechanical issues and deferred maintenance issues within these properties to make the appropriate decision about these sites. To kind of fast forward a little bit on this, what Fannie Mae has done, and I've become recently a big fan of the agencies and their kind of approach to this. And I'll share one of the letters that came out recently, that was sent out by Jody Horn, at Fannie Mae, and outlining the future of condo lending. And I've become a kind of a big fan because they're very concerned about the consumer protection aspect of this, right? And one of the issues that's come up since these guidelines were issued in 2022 was special assessments, and the identification of special assessments, which, by the way, isn't a new guideline. It's been in existence for a long time. But what's changed about special assessment evaluation is that if you have a special assessment, as an example, in on a that's being paid by condominium unit owners, or essentially that's been created so something can be paid for within the development, it's your obligation now as a lender to look into that special assessment and figure out whether or not that special assessment repair cost is for a significant component within the development, like an HVAC unit or a roof. And the agency's contention, and it's both Fannie Mae and Freddie Mac, is that condominium associations should be financially healthy, right? They should be setting aside, just like owners of homes are and regular single family homes are, they should be setting aside enough money in their budget, in their yearly budget, to pay for the future repairs as they come up. And the issue that the agencies have with special assessments is that it's a terrible financial strain for some homeowners. We have seen special assessments in excess of $2,500 a month for a period of over 3 years, in addition to regular maintenance in a condominium property. And these weren't some, $5 million luxury units. They were $700,000-$800,000 condominium units. And the reason for the special assessment was because over the last 10 or 15 years, no money was put into a reserve account by these associations, and they've operated without this budgetary setup where they've set aside reserves. I understand that's been the industry model in many cities across this country, but it's changed. And, again, something I've said before within these meetings is a comment I'll attribute to, my dad, who, as a teenager, used to say to me, what was, and what is, right? And it was usually because I was doing something stupid. But the reality is the guidelines have changed in that regard. The special assessments are no longer a good funding model for repairs to condominium developments. The only caveat I'll make to that statement is, look, there are condominium associations that have $2-3 million sitting in a reserve account, and they create a special assessment for a major repair because they don't want to, take from that kitty, from that that fund that they've created. So they create a special assessment in order to do a major repair or major renovation because they don't want to take the money out of their reserve account. And by the way, that's something that's usually accepted by Fannie Mae or Freddie Mac, meaning that, that's a great way to finance repairs and maintenance if you have an established and large reserve account that you can pull from should any major component repair come up in the future. The rule of thumb, by the way, within the industry, and this is in the reserve study world and in the engineering world, is that a condominium association should have the cost of the most expensive repair in the development sitting in cash in their reserve account. So if the elevator repair cost is $400,000, that should be the minimum amount of cash they should have in their reserve account. And that's just not the case for thousands of developments across the country. But it's about to change based upon these new guidelines because they're going to have to get their financial house in order. The other significant part of these guidelines is that Fannie Mae is really trying to, and Freddie Mac is really trying to, reduce costs of document acquisition. And, there's a lot of stakeholders out there that are charging significant amounts of money for condominium questionnaires and documents as they relate to the, to the requirements for lending review. And through Fannie Mae's new requirement that every loan and every project has to be entered into their condo project manager system, eventually, I think that so many projects are going to be in there that you're going to have, or the agency is going to have the ability to give you I'm going to say, a partial green light to lend in the property. You're always, as a lender, you're always going to have to look at every single loan. Even if it is in CPM and approved within CPM, you're going to have to look to see if there's any deferred maintenance, if there's any delinquency on maintenance payments in the site, if there's any new litigation on the site, what the percentage of owner-occupied units are. But by and large, I think the requirement for submission through CPM and putting all these loans into CPM, which goes into effect on September 18th, is going to eventually make it easier for lenders to lend in condominium projects that meet Fannie Mae and Freddie Mac's guidelines. Within the letter that, and we have around 5 or 6 minutes left to this today. Within the letter that was put out by Jody Horn, the Director of Single Family Collateral Risk Management, she really does a very good job in outlining what Fannie Mae's position is here. And I encourage you to read this letter that was put out because it gives you a nice little kind of, behind the scenes look into what Fannie Mae's, policy is and where these, new requirements are coming from. And within this letter, it outlines very clearly this is really a consumer protection issue, and the agencies are really looking to prevent, condominium lending in properties that just, aren't, as compliant as they should be, or as financially healthy as they should be, or have physical issues within them. That being said, there is I wanted to make this announcement today, and I'm going to go back to one of the guidelines, but there's a MBA Condo Lending Summit that's coming up next week, which if you're a Mortgage Banker Association member, or even not a member, I think you can attend this event. It's a really critical event right now, and both Fannie Mae and Freddie Mac are going to be speaking at the event. I'm doing a presentation at the event about deferred maintenance and property condition and how to kind of get those documents easily, and providing that information to lenders across the country. But most large lenders and lots of small lenders are going to be in attendance next week. And a lot of the issues that are coming up and a lot of the questions about these guidelines that have come up are going to be addressed at this event. And one of those guidelines, by the way, and one of those issues, and the topic we do have to talk about today, and the final topic today, is really, insurance policies. I woke up this morning and was having my coffee and was watching Channel 4 News, and there was a whole segment on Florida and how three new major insurance companies have pulled out of Florida and will no longer provide insurance policies in Florida. And this is happening in Florida, and this is happening in California. And in Florida, there is a state insurance company called Citizens Insurance. And there are some questions on whether or not a policy through Citizens Insurance is compliant with Fannie Mae lending guidelines and Freddie Mac lending guidelines. And that's going to be one of the issues that's addressed, I think, at this MBA Condo Lending Summit next week, because Fannie Mae will not allow a project eligibility waiver to be provided. So I'm going to give you an example. If you're a lender and you have an issue on the insurance policy or a question about an insurance policy that an HOA has, you can't go through their waiver process at Fannie Mae to ask a question about that insurance policy. In fact, Fannie Mae specifically states that you can't get a waiver for insurance or issues with insurance. And that creates a little bit of a problem for lenders because they have to essentially make the decision on their own on whether or not the insurance policy for the site is compliant, or we have to make the decision at Condotek if we're doing a condo project warrant on the site. And in many instances, with these new national insurance issues and national insurance companies moving out of states because of the losses they've incurred, it's a big issue. And it's going to impact lots of condominium lending across the country. I could tell you that in Florida, we have seen several instances, and also in California, where insurance costs for an HOA have gone up by more than 100% in the last year. And I've seen one or two properties where insurance costs have gone up by more than 300%. So think about this from a global, kind of way of looking at condominium lending across the country. If insurance costs are going up and inflation has gone up, and on average, maintenance costs have gone up substantially within condominium developments because of those two things, you're looking at qualification for borrowers becoming more difficult, and you're looking at a lot of extra cost that is being spent by unit owners to live in a condominium development. Condos are an essential part of the nation's housing supply, and the agencies are very well aware of that. And these insurance issues are really creating havoc throughout the industry. And we really just don't know where they're going to land yet. So hopefully in next week's MBA event, we'll be able to get additional guidance. We'll be putting out that guidance and letting you know what that guidance is based upon the information provided at that event. And then the final point to make here today is really about Fannie Mae's unavailable list. Tracking project ineligibility or eligibility through the CPM system is great. And I think eventually, as I said, it will be fantastic. For right now, you're seeing a lot of condominium developments being added to Fannie Mae's unavailable list. The problem with that is that it's a little bit difficult to get a property off the unavailable list. We found that the best way to get a property off the unavailable list is to submit that property to Fannie Mae for a PERS project approval. We've seen a few instances where a lender has, taken the time to submit documentation to Fannie Mae for a property to be released and get taken off that unavailable list. But that, I think, is an issue that's going to come up over and over again. I've said it on the last 2 or 3 webinars, where you're going to see Fannie Mae really providing, or adding a lot more sites to that unavailable list because they're running through them, right? They're seeing more of them. And frankly, the CPM submission process, even though I think eventually is going to be great for the country, I think it is going to result in a lot more properties going on to the Fannie Mae unavailable list in the near future because there's a lot of non-compliance out there. So finally, Look, tracking individual project eligibility, I think is really important. The implementation of these guidelines into the permanent guidelines by both Fannie Mae and Freddie Mac. And it's important to say that the agencies have really kind of aligned on their requirements when it comes to, critical maintenance and critical, deferred maintenance or significant deferred maintenance, and requirements for review of reserve studies or engineering reports, and the substantial creation of reserve accounts for these developments. I think the agencies are pretty close. There are a couple of differences in the guidelines, but by and large, they're pretty close in their requirements. I think it's eventually going to be great for the industry. Right now, what we have to figure out is not not how to, complain about this, but I think how to really align condominium developments and HOAs through an education process of what's required now, because I think that these policies are for the good. And it may be an unpopular opinion, but from what I've seen over the last year or so, many condominium developments are non-compliant and should be compliant and really are financially strapped, and they shouldn't be. So finally, these guidelines and these links are going to be up on our website. You'll be able to review these guidelines specifically. We will provide you with an update to the insurance regulations and the additional questions we have for Fannie Mae and Freddie Mac that arise out of next week's MBA meeting, and send out to everybody who's on this call today an update and what those guidelines and what those answers are going to be. If you are struggling with repurchases as a lender, we're a great resource for review and a very good analysis of a condominium project that is risk averse, but in this environment, we have to be risk averse. So thanks for the time today. We're a couple of minutes over, but the guidelines are now permanent. The changes are in effect. And September 18th, any new loan applications that go to Fannie Mae or Freddie Mac have to essentially be compliant with these new, now permanent lending guidelines. Thank you, everyone. Thanks for spending some time with us today.